Good afternoon, students. Let's start our lecture with a simple question. Imagine you want to start a pizza delivery company, pizza delivery business, so you need a car. But you only have 1,000 in your pocket. A good car costs $50,000. What do? So you have two choices. Waiting for 5 years to save enough money to buy the car and buy the car with a loan, with a debt. But there is a third option, only one that many big companies use. You can rent the car for 4 years, use it, you deliver pizza, and then give it back. In the business world, we don't call it renting, we call it leasing. So today we are going to talk about leasing. So, what is leasing? I'll give you a simple definition. It's, in simple terms, leasing is a contract. It is an agreement between two parties. The lessor, this is the user, the person who needs the equipment, and the lessor, this is the owner, the bank, a leasing company, or it may be a manufacturer. The lessor buys the asset. It may be machine, truck, or building, and let a fixed amount of money every month. In leasing, ownership and use are separated. The lessor owns it, the lessee uses it. Why is leasing an investment activity? When we say investment, most people, but investment is really about using money today to create more money tomorrow. Leasing is an investment activity because, first, it preserves capital. Instead of spending $1 million to buy a machine, the company pays $10,000 a month. The company invests the rest of the money. They save it into other parts of the business. Marketing it generates income. The leased asset, tractor, printing press is used to produce goods or services. The company makes a profit from using something they don't legally own. So, leasing is a financial strategy that allows companies to start a project without huge upfront costs. To understand how leasing works in investment, you need to know the main types of leasing. Financial leasing. What is it? This is a long-term lease transferring risks and rewards to leasing, treated as asset purchase on balance sheet. What does it mean? The lessee is responsible for maintenance, insurance, and taxes. At the end of this contract, the lessee buys an asset for a small amount of money. This is like taking a loan to buy an asset. The company treats it as if they own it on their balance sheet. As we mentioned above, finance lease lasts almost most of the asset's life, but operating lease is short-term lease. It's shorter than the asset's life, and the lessor is responsible for maintenance. At the end, the lessee simply returns the asset. This is like renting. It's good for assets that break quickly or become outdated, like computers or maybe cars. Own a warehouse or piece of machinery that your business uses every day. You need cash to grow your business, but you don't want to move or stop working. Sale and leaseback, the type of leasing, lets you turn that asset into cash while keeping it for your daily work. You do two things at the same time. Immediately lease it back from the company. You got a lump sum of money, but nothing changes in your operations. Simply pay a monthly lease payment instead of owning the asset.
Спасибо.
So students, let us check your opinion on investing decision in different situations. The first scenario. Sarvar is starting a food delivery business, which we have mentioned above. He needs a car. He has 5 million sums in savings, but reliable car costs 150 million songs. The car will be driven heavily every day. After 3-4 years, the car will have lower sale value and new delivery technologies may become popular. Server is not sure he wants to own the car for a lifetime. So the question is, should Server take bank loan, lease the car, or wait until he saves enough to buy with cash? Explain your...
While leasing is the right choice, he can start immediately. He only has 5 million sums, but lease requires a small first payment, often 10 or 20%. He can get the car and begin delivering food right away. Low monthly payments, lease payments are usually lower than bank payments. Bank loan payments. It helps him manage cash flow while building his business. No risk of losing money of the car. The car will lose value quickly because of high mileage. With a lease, he doesn't own the car, so he doesn't lose money. When the car value drops, and the leasing company takes that risk.
As a textile factory owns a plot of land and wants to build a new production workshop to increase capacity. The company already has several loans and the bank refuses to give another large loan. However, the factory has an old warehouse and some unused equipment that are fully owned but not used at full capacity. So the question is, how can the company obtain financing for the new workshop without taking a traditional bank loan? Propose an alternative and explain why it will work.
The company can use a sale leaseback or asset-based financing strategy. It can sell its old warehouse or unused equipment to an investor or leasing company and receive immediate cash and then lease the assets back if needed. This works because it unlocks money from existing operations without taking a new loan and avoids bank restrictions and provides funds to build to operate new workshop.
The Noza gave us a very complete answer that shows that she has strong analytical knowledge in investing. So the second question is, a group of software developers is launching an IT company. They need powerful computers and servers worth 40 million songs. Technology improves quickly every 1-2 years. The founders have enough personal savings to buy the equipment, but they are afraid that in 1 year the hardware will become obsolete and lose value. A bank is willing to give a loan, but it requires one founder's apartment as collateral. So the question is, should the startup buy the equipment with their own cash, take the bank loan, or consider another option? What alternative would protect them from technological obsolescence?
Okay, I think the startup shouldn't buy the equipment with their own cash because technologies becomes outdated very quickly, and another option is taking a bank loan is also very risky because the bank wants an apartment as collateral. And the better option is leasing an equipment because this way the company can use modern computers without spending a lot of money at once, and they can upgrade the equipment later. And also another good option is using cloud services instead of buying expensive servers. And I think leasing and cloud services would protect the startup from technological obsolescence and reduce financial...
When companies plan their investments, they look at the pros and cons. Let's use simple language to list them. Advantages. You don't need a lot of cash to start. This is the biggest advantage. Protection from obsolescence. Imagine you buy a very expensive new computer. In 2 years, a much better one comes out. If you list it, you can just give the old one back and list a new one. You avoid the risk of owning old technology. The third benefit is flexibility. Operate in many countries, lease payments are considered operating expenses. This means they can be deducted from revenue before calculating taxes, lowering the tax bill. So there are disadvantages too. High total cost. Usually, leasing costs more in total than buying, which cash units. No ownership. At the end of the finance lease, you often own nothing unless you pay a final lump sum. Penalties. If you want to end a lease early, there are usually heavy fines. So, how does financial manager decide to use leasing? Leasing is best for small and medium-sized businesses that have limited cash but need expensive equipment to grow. It is also very common in industries where technology changes fast, like IT, medicine, and aviation.